Financial markets flipped the script this week, and you won't believe what triggered it. Fed Chair Powell hinted at rate cuts, and global markets went into overdrive. From a Dow record high to a retail-fueled rally in China, it's all happening fast. What does it mean for your money, your strategy, your edge? You won't get this level of insight on CNBC. This is Weekly Market Update, the podcast where two generative AIs, supervised by a former senior portfolio manager, deliver the sharpest global market breakdown in the game. We decode what really matters, so you can move before the market does. Don't scroll past. Listen to the full episode now, before everyone else catches on.
What a week. We saw this almost unbelievable shift in the markets, didn't we? Federal Reserve Chair Jerome Powell. I mean, one speech, and it felt like the whole game changed.
It really did. It was quite something.
Yeah, it wasn't just a turnaround. It was like a complete rethink of expectations. Sent the Dow to a record high. And the surprising part, value stocks, small caps leading the charge, tech, not so much. It's a really fascinating pivot. Okay, let's unpack this. What does this sudden shift mean for you, for your investments, for understanding this global picture?
Well, what's fascinating here is just how fast things can change based on what a central bank says, or even just hints at. Powell's tone at Jackson Hole, it wasn't just a minor adjustment. It felt like a clear signal. You know, the Fed's thinking is evolving, and bam, markets repriced almost instantly across the board. So our mission today really is to get into those regional details, look ahead at what's coming down the pike next week, and flag the key risks you absolutely need to keep an eye on. It just shows how interconnected everything still is, very sensitive.
And you really saw that shift, that recalibration right here in the U.S. markets. Most of the week felt, I don't know, a bit hesitant. But Friday, whoosh, completely different story. We saw this really stark split in performance. The Dow Jones surged up over 1.5%. The S&P 500, it did okay, gained 0.3%, and actually broke a 4-day losing streak. But the NASDAQ, the tech stocks, actually lost ground, down, 0.6%? But the real standouts were the smaller companies. S&P Midcap 400 jumped nearly 3%. And the Russell 2000, our small cap index, soared over 3.3%. So what lit the fire under those specific areas?
If we connect this to the bigger picture, it was Powell. His comments were a major reset button. He specifically mentioned, rising risk to jobs, to inflation. He hinted rate cuts may be warranted. And the key phrase, I think, was because rates are already high.
Right. That felt new.
Exactly. It wasn't just tweaking. It was like opening the door to maybe easier money sooner than people thought. And the market reaction, immediate. Treasuries rallied, yields dropped, especially short-term yields. And that FedWatch tool, the one tracking futures, now showing an 83.1% chance of a rate cut in September.
Wow, that high already.
Yeah. So this dovish tilt just completely reset expectations. And it's interesting because it shows the market moving away, maybe, from just pure growth at all costs. Now it seems to value, actual cash flows, solid balance sheets more. Because if the cost of money might actually go down, then suddenly those cyclical sectors, the ones sensitive to rates like energy, financials, materials, they look a lot more attractive, right? They thrive on economic activity, lower borrowing costs.
That makes sense.
It feels like a real rotation, driven by that potential change in the cost of money itself, not just a flash in the pan.
That's a really key point about what the market's valuing right now. And it wasn't just the Fed talking. We got some pretty mixed economic data too, didn't we? Housing, for instance. July existing home sales, they were up 2% month over month. Good sign, maybe helped by mortgage rates easing a bit.
Possibly, yeah.
Then the labor market showing some, interesting signs. Initial jobless claims ticked up to 235,000. That was higher than expected. Continuing claims edged up too. But then here's where it gets really interesting. The August composite PMI, that business activity measure, jumped to 55.4, highest level this year, 2025. Manufacturing PMI also looked good, a 39-month high.
Strong numbers.
But businesses reported the sharpest rise in input costs since May, and they're pointing fingers directly at tariffs. So how do we square that? Strong activity, but rising claims and these cost pressures.
It's an excellent question.
Okay.
And it really highlights the tightrope the Fed is walking. On one hand, strong PMI suggests the economy's resilient, still has momentum. That's good. But those jobless claims creeping up, and especially those tariff-driven input costs, Those are big warning signs.
Yeah.
They could really muddy the waters on inflation. Makes it harder for the Fed to cut rates if you got this supply-side inflation sticking around, even if, say, the job market weakens. It's definitely something to watch closely. Those costs could really start to bite into company profits down the road.
Yeah, that tariff angle feels persistent. Okay, so while the U.S. was digesting Powell's change of tune, what about the rest of the world? Let's shift over to the Eurozone. Generally looked positive there this week, right? Though maybe some differences between countries. STYO-XX, Europe 600 up over 1%. Italy's MIB, strong performer, up over 1.5%. France's CAC added about 0.5%. Germany's DAX, though, pretty flat.
Yeah, Germany was flat. And this raises an important question about the underlying strength. Is it sustainable? We definitely saw business activity pick up. That flash Eurozone PMI number, the early read, rose to 51.1. That's the third month of expansion. And manufacturing, crucially, grew at its fastest pace in over 3 years. That's significant.
Okay.
Even Germany, despite the flat market, showed some stability.
Yeah.
Output up for the third month.
Yeah.
France, which has been lagging a bit, showed some improvement, even if it's still technically contracting. But here's the split. Consumer confidence actually went down in August. Slipped a bit.
Oh, interesting.
So businesses are sounding more upbeat, but consumers still seem cautious, maybe feeling the hangover from past inflation or just general economic jitters. That could be a problem for growth later if people don't start spending more confidently.
Fascinating split there, business versus consumer. Okay, from the Eurozone, let's pop over the channel to the UK. The FTSE 100 actually closed the week at a record high, up a solid 2%. Strong week.
Very strong week for the FTSE, no doubt. But the UK's got its own persistent headache. Inflation just keeps ticking up. UK CPI hit 3.8% year over year in July. That's up from 3.6%. And services inflation climbed to 5%.
Ouch.
Yeah, that really keeps the pressure on the Bank of England to stay, hawkish, even while other central banks are maybe thinking about easing. But what's interesting is this inflation fight is happening while growth actually looks okay. Composite PMI went up to 53.0, driven by services. June house prices were up strongly, too.
So they're growing, but inflation's still hot.
Exactly. So the BOE is walking this really fine line, trying to cool inflation without killing that underlying growth. It's a very different policy puzzle than in the U.S. right now.
A completely different challenge. Okay, let's head east now to Japan. Bit of a different story there. Markets were actually down. Nikkei 225 lost almost 2%. TPRX was down a bit too. What's driving things there? Still inflation worries.
Japan is absolutely grappling with inflation pressure. And it's really pushing the Bank of Japan into, new territory for them.
Right.
We saw the 10-year JGB yield, that's their government bond, rise to 1.61%. That's near a 17-year high.
Wow.
Yeah, it shows the market is clearly expecting higher rates. Core CPI for July, still stuck at 3.1% year over year. That's well above the Boday's 2% target. So inflation seems pretty sticky there.
Right.
And adding to the mix, their exports actually dropped in July, over 2.5% year over year. Partly U.S. tariffs, partly just weaker global demand. So you put all that together, and markets are now seriously betting on another Bank of Japan rate hike, maybe even as soon as October.
Really? A hike?
Yeah, which would be a huge shift away from decades of that ultra-easy money policy. It's creating a lot of uncertainty for their economy and markets.
That's such a contrast to the U.S. and Europe talking cuts.
Yeah.
Okay, final stop. China. Mainland markets there saw this absolutely massive surge this week. CSI 300 up over 4%. Shanghai Composite gained nearly 3.5%. Even Hong Kong's Hang Seng saw a small gain. Big moves.
Huge moves. But what's really unique in China right now is who's driving it. It's almost entirely a retail investor rally.
Yeah, the retail crowd.
Yeah, everyday investors jumping in, reacting with huge enthusiasm to any hint of better U.S.-China trade relations. But, and this is a critical warning sign, you need to be aware of margin financing.
Borrowing to buy stocks.
Exactly. It's hit its highest level since 2015. It's now just 10% below the all-time record highs.
That sounds risky.
It is. You've got very low interest rates in China, not many other good places for households to put their money, so they're piling into stocks, often on borrowed money.
Yeah.
This kind of retail frenzy, especially with margin debt near records, it always makes me nervous. It feels a bit like musical chairs.
Right.
Everyone's having a great time while the music's playing, but when it stops, people can get hurt badly. So while the rally looks great on the surface, that leverage underneath adds a big, big element of risk.
That Chinese leverage story is definitely a stark reminder about risk, even when things look good. Okay, so we've covered the globe, seen these complex dynamics. The big question now for everyone listening is, what's next? What should you be watching in the week ahead, August 25th to the 29th? What could confirm or maybe challenge these trends we're seeing?
You're right. Next week is absolutely crucial, packed with data releases that could really move the needle. In the U.S., Monday we get new home sales. Tuesday's important. S&P Case-Shiller home prices and durable goods orders gives us a read on consumers and business spending. Thursday, the second look at Q2 GDP, plus pending home sales and the weekly jobless claims. Always important. But the main event, probably for the whole week globally, is Friday, the PCC price index.
The Fed's favorite inflation number.
That's the one. Plus, we get University of Michigan sentiment on Friday, too.
Yeah, that PCE number feels huge given Powell's comments. It could really validate his dovish lean or maybe push back against it.
Precisely. It is the absolute key. Then over in Europe, Monday starts with Germany's IFO business climate. Wednesday, we get German GfK consumer confidence. And Friday is big for Europe, too. Flash inflation numbers for France, Italy, and Germany. Essential to see if those green shoots are holding up, or if inflation pressures are building there too, which complicates things for the ECB. And finally, Japan. Friday brings their consumer confidence. That'll give us a clue about how the average person there is feeling about rising prices and this talk of rate hikes.
Yeah.
A lot coming up.
Definitely a packed week. Okay, so to help you navigate all that, let's drill down into our top 5 risks for this coming week, August 25th to 29th. This is really about helping you stay proactive, understand the potential bumps in the road.
Exactly. Knowing the risks means you can anticipate, maybe position yourself rather than just reacting after the fact. Okay, risk number 1, U.S. inflation surprise. PCE index, August 29. We just talked about it. It's the Fed's preferred gauge. If that comes in hotter than expected, especially the core reading, it could just completely derail hopes for that September rate cut. And you'd see volatility spike again in rates and stocks as the market frantically reprices the Fed's path. It's the absolute linchpin.
Got it. Number 1 risk. What's next?
Number 2, labor market deterioration. Powell specifically mentioned the weakening job market at Jackson Hole. It was part of his reasoning for maybe cutting rates. So if we see jobless claims keep rising significantly, or maybe we get some other surprisingly weak labor data, it could suggest the cracks are deeper than people think. That would seriously challenge the soft landing story the market likes right now, and probably bring recession fears back to the forefront.
Okay, makes sense. Risk number 3.
Number 3, tariff-driven cost pressures. Her business is already feeling this, right? Input costs rising sharply, blamed largely on tariffs. If that keeps up, it's going to squeeze company profit margins. That weighs on earnings down the line. It also makes the central bank's job harder because it's that supply-side inflation, which monetary policy isn't great at fixing.
Right, a tricky one. Number 4.
Number 4, China's leverage-fueled rally. We just discussed this. That margin debt near record highs, driven by retail mania. The risk. A sharp mood swing. Maybe some bad news, maybe regulators step in, and suddenly everyone rushes for the exits. You could see a rapid, messy unwind of those borrowed positions. And that wouldn't just stay in China. It could easily ripple through emerging markets, and even globally.
Yeah, that leverage makes it fragile. Okay, final risk.
And number 5, diverging central bank paths. We're seeing this clearly now. The Fed is maybe tilting dovish, thinking cuts. Meanwhile, Japan's BOJE is under pressure to hike rates. UK inflation is still hot, keeping the Bank of England potentially hawkish.
Total opposites.
Exactly. This divergence, these different directions, can cause big swings in currency markets, FX volatility. It increases the risk of a policy mistake somewhere, and it can disrupt how money flows around the world as investors chase yield or safety. It just makes the whole global investing landscape much more complex and fragmented.
What a week it was, and what a setup for the next one. So wrapping it all up, Fed Chair Powell definitely shifted the mood, breathing new life into markets, especially value and small caps here in the U.S. That rally has legs, it seems, but next week's PCE inflation number and the updated GDP print, they're absolutely critical tests. Will they confirm the Fed's pivot or throw cold water on it? And beyond the U.S., keep a really close eye on consumer confidence and those inflation readings out of Europe and Japan. Because as we've laid out, central banks globally are starting to sing different tunes, and that creates really interesting and potentially challenging new dynamics for your portfolio.
Indeed. That balance central banks are trying to strike between managing inflation and supporting growth, it's getting trickier, and it looks different in each region now. And as we've seen, the risks haven't gone away, whether it's leverage in China or those stubborn tariff costs. These things persist in our interconnected financial world. It creates this constant tension, this dynamic push and pull that you as an investor have to constantly navigate. You're weighing the signals from policymakers against the hard economic data, against the unique quirks of each market, really understanding these complex links, these interdependencies. It's not just about making good decisions today. It's about trying to anticipate that next major shift on the global financial chessboard.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, Tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.